So, see, tight stop, long take profit range. And as we go up in price, as we clear some of our take profit or dollar cost averaging price levels, this stop has to come up with it. This stop doesn't stay down here the whole time you hold the contract. Because what's going to happen is over the time of the contract, especially if it's a contract, let's say you got a contract that expires 2-3 months out, what's going to happen is you're going to keep getting hit with data day over day over day over day. And as you get closer to expiration, the data gets bigger and it gets more impactful in your contract. So the less price movement you have, if you're not going up and we're not getting closer and closer to this take profit, if it starts staggering around in here for too long and that data starts impacting you too heavily, then you're going to have to get out because, yes, we may have cleared this take profit level right here. I mean, we may dollar cost averaging at this level right here. And between this level and this level, it starts floating around, floating around. But our stop loss is now going to be moved up to where we entered with our dollar cost average in position. So if we close any kind of daily candlestick below that level, that's where we have to exit. And we're going to trail it up. As long as we keep clearing our levels, we're going to trail up the stop to the next most obvious point of support. So if we clear this take profit, this dollar cost averaging zone right here, our stop loss would have to be shifted up to, I would probably shift the stop loss up to this wick right here on the top of this candlestick. And I will stop out at 246. We clear 250, stop loss moves up to 246. You can't keep it at 228 because your contract will lose way too much value if it pulls all the way back down there after 2 or 3 months have passed of you holding a 6-month contract. Can't do it. So the trailing up your stop is a crucial point of options trading and securing profits. That's what a lot of people don't do. They don't trail their stops up, and a lot of people typically don't dollar cost average into their winning positions. So those are two things that require high level of discipline and planning in advance, like setting your levels up to execute. Because if you're just trading, one, you don't ever want to trade blind. So I'm not even going to say if you're trading blind with no levels. But if you're trading without any trailing stop and you start clearing take profit levels and you're getting excited, all right, we cleared this level pretty fast, and you're holding your contract looking for this one to clear, right? And we're going to dollar cost averaging at this level. If you are not monitoring that data and that volatility in the market and we crack below this level and you didn't have that set as a stop for when we got up to this 250, if you didn't have that 247, 246 as a stop, now in your mind, your psychology is going to tell you, well, our original stop was down here and I already cleared my first take profit zone over here, so as long as I hold above my entry, my contract should be in good shape. But you may be up 30% right here on your contract. Your stop loss at that point will have you down probably 89, 80, 70, 80%. Versus when we entered right here, that stop loss would have only had you down, I don't know, let's say 10 to 15% in your contract, maybe. So it's a big difference. So that's why you got to trail that stop up. It is very, very important to do.